So this is a patient business. And those who aren't patient, it's not your cup of tea. It just isn't. So you really got to understand your own investor ID with regards to that.
Welcome to Multifamily Insights. I'm your host, John Casman, and I want to thank you for joining us for another great episode. Listen, if you are listening to the show for the first time, make sure you hit that subscribe button so you don't miss an episode. And if you're an avid listener of the show, we want to hear from you. All right. Leave us a rating and review. Tell us what you love about the show, but also give us some honest feedback so we can make this show work harder for your investing goals. Now, today we've got a great episode. We're going to be talking to Jay Tenenbaum. They say you're the average of the 5 people you spend the most time with. So if you want to grow as a multifamily investor, you have to spend more time with other multifamily investors. And an easy way to do that is to join our apartment investing mastermind group today. Just go to casmancapital.com and click on the mastermind button. Now, as a part of this group, you'll get access to expert trainings, group coaching calls, industry news and updates, as well as all of our webinars and workshops, including our 3-hour workshop on raising capital. Again, if you want to be around other multifamily investors that can help you scale your portfolio today and grow your network, make sure you're a part of the Apartment Investing Mastermind. Just go to casmancapital.com and click on the mastermind button today. Jay Tenenbaum is the partner and president of loss mitigation and asset disposition at Scottsdale Mortgage Investments. Now, in his career, Jay has acquired over 700 distressed mortgage notes and properties in over 40 states. Now, he attributes his success and expertise to his ability to effectively integrate his 20 years of experience as a former debt collection professional. Now, Jay's legal know-how and achievement in resolution in turning non-performing assets into positive cash flow gives him an unmatched perspective in the field. Let's welcome to the show, Jay Tenenbaum.
Thank you so much for having me.
Absolutely. Jay, I went over your bio at a very high level. Why don't you take 2 minutes and fill in some of those gaps?
Sure. So first of all, I envy those who have, second, third, fourth generation real estate experience, because prior to getting into this field in 2013, the only real estate experience that I had was owning the homes that I lived in for myself. In fact, while I'm a distressed mortgage expert, I probably didn't have any clue what I was doing when I signed the mortgage and notes on the houses I lived in. So I've come a long way from there in 10 plus years. In fact, the bio probably needs to be updated because I think we've probably invested in closer to 45. I wouldn't say all 50 states, only because you don't see notes in certain states anyway. But I can give you a little side story. So I was on vacation a couple years ago with my wife and my twin daughters, who are now 15. They were probably about 13 at the time. And we're going around the dinner table. We're having dinner at a restaurant, and we're going around the table, and we're kind of the conversation turns to, let's play a game. Name a vegetable, and you go through the alphabet. Name a vegetable that starts with A, and you go around the table. That morphed into where they learned in grade school some song about how they memorized all 50 states, but they put it to a song, right? So I said, hold on a second, sing that song slowly, and I'll say whether I've ever invested in that state or not. And then we counted. And I think at the time it was like over 40 plus states. That's how I got to that number. And then we bought so many notes in the last couple of years that we lost track. So it's probably updated from there. But that's kind of like you kind of lose track of some of this stuff as you scale up. But really, I was, in the legal world, debt collection. So basically, I've been in debt all my life, just not personally. I fell into this business in 2013. Went to a note buying for dummies workshop in San Diego, and realized that it was just another debt instrument that I'd been used to dealing with, right? So it was kind of came natural. I prior to that, I wanted to be a real estate investor, gone to all the hotel ballrooms like everybody else, but come Monday morning, really didn't know where to find that first deal. And this 4-day dummies workshop, basically the guy brought a couple of hedge funds to the workshop, so I introduced them to the class. So I basically had deal flow at my fingertips from the very beginning. So it was a no-brainer to opt into his course and his mentorship and go forward. And that's really how the catalyst for me. At which point in time, initially, I wasn't sure whether I was using it as how to find deals that I was so challenged with other opportunities, as a as an asset, as an acquisition strategy, or just doing it to maintain cash flow. Because in my prior legal world, we were generating a lot of cash flow from wage garnishments and stip payments and stuff like that. So I was used to that, right? So yeah, that's my forte is basically, since I've ever been in the note business, is keeping borrowers in their homes, at least the ones that won't that don't have trouble getting out of their own way. Um, Keeping borrowers in their homes and creating that win-win situation, and generating cash flow. I mean, it's a lot different than multifamily. Cash flow is the same, but how you get there is different. Like, you're all under one roof, somebody use on the roof. We're all over the place. We're in portfolios, and we're buying paper. We very rarely own the actual house, physical four walls and a roof.
Yeah. Can you, for those folks who aren't as familiar with note investing, right? Maybe they understand somehow you're acquiring the note or the actual debt, but don't really understand much beyond that. Can you just maybe walk us through that process at a high level? Like, what does it actually mean to be a note investor?
Certainly. So basically, you're Joe borrower, and for whatever reason, you stop paying on your loan, right? Because we buy non-performing. You can buy performing loans. You can buy loans that the borrower is still paying on, which you're paying a higher premium for. But we buy non-performing loans because we work them out and get better discounts and and turn them into positive cash flow and higher rate of return for our investors. But basically, you stop paying on your loan for whatever reason, right? Let's say, for example, in the Midwest, your house is worth $200,000. You stop paying on the loan. Your principal balance at the time you stopped paying was 125,000. You haven't paid for 2 or 3 years. Uh, you probably owe more like 150,000, right? We're buying that loan. So basically, you know, Goldman Sachs, whatever, are buying, the loans in huge packages as a commodity from Fannie, Freddie, HUD, et cetera, right? And right now in our marketplace, they're overpaying tremendously for this stuff, right? And ultimately, they just trade it as a commodity. And then it gets down, depending on what level of buyer you are, it gets down to a hedge fund that you can do business with, that's resell it to you. Along the way, nobody's probably even spoken to the borrower. It just gets traded as a commodity more than anybody just works it out. Our forte is when we buy it, we tend on working it. I've done plenty of workouts where the borrower says nobody ever called me before, or the borrower was contacted by the bank or the servicer and said pay or die. Well, I have the money to pay, otherwise I'd be still to pay, right? And I worked it out by just treating with a little dignity and respect, and we work something out. But so we buy it, at a huge discount. When I first started this business in 2013, the discounts were more like, 40, 50 cents on the dollar. House were underwater back then. Now, in the marketplace for years, since it's at equity, yeah, I may be paying 70, 80 cents, 70, high 70s for stuff, but I'm buying larger value assets. I'm paying like 350 for a, $700,000 house, um, that I never own. I only own the paper, right? So again, I own the paper. I have the choice to or do a modification with the borrower or foreclose on the paper, just like a bank would. I step in the shoes of the originating bank all the way from all the way down the trail of assignments of where it's gone. Um, so that's really And then you ask the questions always ask me, well, how do you monetize it? How do you make money at it? Well, again, if the borrower owes, remember when I refer to seller, I'm not talking about the seller of the house. I'm talking about the owner of the note prior to me, right? So I'm buying it from another hedge fund, right? And I'm buying it at a good discount. So let's say again, you owe $125,000 is your legal balance, right? And I'm picking it up for 60,000, right? Now, if I go to auction, if I go foreclose on you and take the property to auction, and you're an investor at the courthouse steps, and when you go to those who go to auction, as an exit strategy, know that when the auction starts, it starts at a certain number. The opening bid starts at somewhere, right? I'm the one that gets on my paper. Our company sets that number. And depending on the equity in the house, I could set that number at 125,000, exactly what I'm owed. Because the house is worth 250, we know a fix and flipper is going to buy the note, because buy the property at the auction. Now, let's say I want to get rid of the house and the property is only worth 150, and I bought it for 60. I may set that opening bid at 90. trying to entice the fix and flipper to still buy it. Now, if the house in some of this market, some of this in the prior to interest rates rising, houses were going off at auction incredibly stupid, right? Problem with that, not the problem with that, is, for example, let's say I'm owed that 125 and the winning bidder at auction paid 300 for it. I don't get that spread. I only get 125. Okay. But I still made the difference between 60 and 125. That's my expenses. Okay. So that's one exit strategy. If I take the property back, now I own it like a fix and flipper. I can
And
rent it. I
Jay,
can.
sorry, just to clarify that point you made, because I think it's a really good analogy and a good example to help people get the notion of note investing, right? So you said you're buying the paper, you're buying the actual mortgage, and what's due on that from the seller, which is the previous holder of the note. And then one of the exit options, you want to get the person to perform and catch up on the payments. But if they don't, you can take it to auction and then you can sell it. The thing I wanted to clarify why I interjected is you said that if you sold it for 125 or if it goes to auction, and someone buys it for 250, you only get the 125. Is that how much is owed on the note? And then the
Correct.
60 is what you pay. So you're saying you might buy it for 60, but if the mortgage is still due 125, you get 125, but you don't get above whatever that borrower actually owns, no matter what you actually paid for that note, right?
Correct. And good question, because that's really what's confusing to people is saying, okay, who's your borrower? First of all, when I say seller and borrower, you got to keep
Yeah.
the party straight. So I'm buying from a hedge fund. The borrower, I've become the bank. Joe borrower still lives in that house. And Joe borrower, like I said, he takes out a mortgage and 10 years ago and he stops paying. Let's say he stops paying and he owes $90,000 on the house, but he hasn't paid for several years, right? So that balance accrues, right? And we call it, there's two components to it: what accrues naturally and what accrues by the lender having to come up out of pocket. So basically, what accrues naturally is I stop paying at $90,000. Now, accrued interest payments and arrearages, et cetera, accrue on that loan all the time I didn't pay. And in the meantime, somebody prior to me probably paid property taxes to keep the property maintained, probably paid servicing, probably paid insurance. That's called corporate advances. Any out of pocket lender has to shell out during the time they own the loan. So the day you defaulted, you only owe the bank 90 grand, but by the time I take it auction, you as the borrower could owe 100 and a quarter. Very, very easy. And I know that when I'm buying the loan, right? I know what the unpaid principal balance is, the amount that when you stop paying, what the balance was, but I also know what's accrued since then. And that's where the discount comes in. I'm buying it off that discount. So if the guy owes 100 and a quarter, I'm not paying 110 for it. I would be stupid, right? I'm paying 60 for it. So now my investment is $60,000. I'm owed, stepping in the shoes of whoever owned it before me, I'm owed 125. If it didn't go to auction, you wanted to call me up one day and said, I want to pay off my mortgage, I'll tell you the number is 125. Or maybe I'd tell you something different. I can tell you 80,000, make 20 just because I wanted to, whatever, depending on what the circumstances were. So that's where the profit is. And again, anything above what I'm owed, that goes to statutorily to any other junior encumbrances or ultimately to the borrower themselves.
Yeah, I didn't know. I appreciate that clarification because I think that's one of the things that trips people up. And if I'm understanding from the way you described it, it sounds like you're focused more on first lien positions versus second or junior lien positions. Can you just clarify and explain a little bit about that?
Correct. Well, at first, we've only bought first position liens for several reasons. One is we like to be in first. I mean, we get to control everything, which is good. Second of all, in my prior experience, one of the reasons I stay away from second liens, two reasons why. One is when I first got started in this business, the sellers of second liens weren't the most reputable people. You buy the loan and you couldn't get the collateral, and it was just like, come sue me, I don't really care. And you're beholden to the first, and so some of your exit strategies are somewhat limited at times. But the other piece why I've always stayed away from seconds is that prior to getting a note investing, I was buying judgment liens in California and executing on real property. And let's say I bought a judgment lien that was in third or fourth or fifth position, right? I'm buying a $10,000 judgment lien for $400, and I come to you and I'm in fourth position, right? I can't foreclose on your property. I don't want to. I don't want your house, right? I'll take a couple of $1,000s, right? You owe me 10, but I'll take a couple thousand. I made 400. I only bought it for 400. No, Johnny down this, your neighbor next door told you to go spend $5,000 to a BK attorney and strip my lien. You could have gone out for two, but you're going to spend five. I'm being exaggerated, but it was just too easy to strip the lien. And
Mhm.
what I mean by stripping the lien is the second goes away during bankruptcy court by showing that there's no equity between after the first. So it just became
Mhm.
too easy. So it was the question of not if I get stripped, because then I lose my interest, right? Not if I get stripped, but when I get stripped. That's why I stay away from seconds. It's just too easy for borrowers just to strip me. And they can't strip a first in most cases. So that's
Yeah.
why. That's why.
I think that's really good to know and really helpful because we've had guests on in the past talk about their approach, and I've had, I've heard all different strategies, right? From those who invest in second position liens, non-performing second position liens, those who focus only on performing notes, those who focus on non-performing notes after
Right.
performing notes, which is like picture a performing first position with a junior lien that's non-performing. So we've heard different
Right.
strategies. So it's always interesting just understanding why people think of it the way they do. The other thing you
Second,
said was,
second position experts love that space. I mean, it's everybody's cup of tea. Those guys love their space because basically, when they hit a home run, they hit a home run. Like for example, just hypothetical. Let's say in the second space that $125,000 second was a second. They may pay $10,000, $15,000 for it, right? So then let's say the guy pays him off. That's a huge home run. Now, when I first got this business, guys would tell me I'd buy, let's say I bought 10 seconds and I probably threw three or four of them in the garbage because I couldn't do anything with them. But they probably hit a huge home run on four or five of them that made a profit over and above their investment on the whole package.
yeah,
It's
no, it
kind
makes
of like
sense,
or
right?
kind of like oil drilling, right? They're kind of wildcats. They go for that big score.
Yeah. Well, the thing I hadn't heard was just how easy it is to strip off those liens, right? That's what I didn't know about. So that's why I thought it was
Yeah,
really interesting, just understanding the drawbacks on some of those things. The other thing that I've heard from folks is that, the jurisdiction matters when you're doing this, right? Because every
absolutely.
market has different laws. Talk to me about that. You've invested in 45 different states at this point. So talk to me about kind of, are there states that you would avoid or what are you looking for before you take on a note in that market.
So we all know Warren Buffett has his sayings. When people are running towards something, you run away, and vice versa, right? Um, Really, there are jurisdictions that I'm not a fan of. I'll tell you that. But and I have a specific love-hate relationship with Illinois, only for the reason that Illinois and their bureaucracy and their rules and stuff just drive me freaking nuts. But I've done very well monetarily there, right? I've scored some major wins there, just because. So it's hard for me to stay out of it as a rule because I've done really well there. Um, Jurisdictions, there's basically break it down to judicial and non-judicial states. The non-judicial states, mostly in the West Coast, California, Arizona, Nevada, blah blah blah, are those where it's a deed of trust state, and the foreclosure process is very fast, right? It's statutory. It's just that's the ones that most people are familiar with. The courthouse steps. It's boom boom. You file a notice of default. 90 days later, you record a notice of trustee sale. 21 days later, in California, you're at auction, right? For the most part. Judicial states is you file an actual lawsuit and you go through the court process. Now, yeah, people say, well, I want to go the fast way. Well, the fast route, you're paying more for the loan. So I'm getting bigger discounts by being more patient. So, that same hypothetical, that $125,000 loan, non-judicial, I'm paying $100,000 or more for it, and being, hypothetical, and being facetious a little bit, or I'm paying 60 in a non-judicial in a judicial state.
No, it makes a lot of sense there. And I appreciate you sharing that because that judicial versus non-judicial, you're right. I think the natural reaction for most people is, well, I don't want to wait, right? As investors, we want to get our money as fast as possible. So, hey, I'm going to go the short route. But what you're saying is, hey, because of that, there's going to be a little less competition in these judicial markets, and you could probably get greater profits on the deals you're doing if you could have a little bit more patience. So, always something to consider, just recognizing why people, move away from one area or go towards something else.
Right. I mean, like I said, and as you mentioned earlier, as a multifamily investor wants to scale up, I've been fortunate and blessed to had the ability to scale up my business in the 10 years, right? So I've got such a pipeline. We own probably 130, 140 loans right now. So I'm not worried about that one loan that's stuck in New York for the last 3 years, right? Or whatever. I'm not worried about that because I just ultimately I'm in first position. I'm gonna prevail. We
Yeah.
just know we are. I mean, you do the right diligence, you do the right things where you know that the tax you're not going to lose the property tax sale and things like that, the impediments that could challenge you. Um, so if you do your diligence right, you know that time, you know, time is your enemy and time is your benefit. Time is your enemy for those who are impatient. This is not a get rich quick, fast paced kind of program. It's just not. And a lot of investors get into note investing expecting that quick turn. And the reality of it is when I go, speak in forums and stuff, I can tell you a story about a note that got paid off at auction within 3 or 4 months that I bought it. But I can tell you notes that got paid off at auction 3 years after I bought it, right? I mean, but people will listen to, oh, you got paid off, this is how much money you made in 3 months. Well, yeah, but that's not, you build your pipeline, you got sheriff sales going on every month. So this is a patient business. And those who aren't patient, it's not your cup of tea. It just isn't. So you really got to understand your own investor ID with regards to that. And you take on, when I told you, in a high level view, judicial and non-judicial, and then you've got your judicial states, New York and New Jersey take longer than Indiana. Okay, they do. The pricing will affect that, right? And you figure out how to do, we've got little niches in how to make money in New York because where people are running away, we run towards it because we've got a good legal team that knows how to navigate New York a little quicker than most. Okay, we do. Um, but a lot of people say, New York takes too long, and they do things, and they got some crazy rules as well that kind of, they're not. Some states are not as investor friendly or bank friendly as others. You know that from experience. You know that going in. But again, if you buy it right and you're patient with it, you're fine.
You talked a little bit about due diligence, doing the proper due diligence, understand the time frames, the laws, all those kind of things. You have 4 steps you follow for due diligence. Can you explain those for us?
Sure. Basically, the 4 steps in a high level variety are I want to let's call the first one title. Title is not I'm worried about. I know the borrower owns the property. At least in my diligence, I got to confirm that my borrower owns the property. The borrower that took out the loan and mortgage I'm projecting to buy owns the property. But when I say title, I'm really more looking at that when it was originated from Bank of America and then assigned to U.S. Trust and then assigned to hedge fund B and hedge fund C, that all the assignments line up. It's not fatal if they don't because you can always go have a custodian fix them. That's the first thing. Taxes is the second thing. I want to know what the current taxes are. I want to know what the delinquent taxes are. I want to know how far back the taxes are delinquent and whether or not they've been sold at tax sale yet. Whether and really there's delinquent taxes should not scare off a note investor in their diligence. You just got to know where you are. And what I mean by that is taxes go from current to delinquent to in most jurisdictions where the lien is sold to investors. Then there's a redemption period where someone has the ability to come in and pay off that lien, right? And you got to know what the redemption period is. And then when the redemption period expires, it's okay. Some states are automatic that once the redemption period expires, you've lost that property to tax sale. Others are I can come in and redeem it before the investor gets his deed. Okay, great, right? So I got to know where the taxes are. I got to know they still got a valid first position mortgage. Um, for us, because we want to be able to talk to borrowers, occupancy is important to us. It's not necessarily a major diligence factor, but it's important to us because we want to make sure that if we have the ability, we have maintain those exit strategies to do a workout with a borrower, right? And the last is value. I want to know that I'm buying that $125,000 legal balance for 60 grand because I got a house that's worth 250. If it's worth 180, if it's worth 100 and I'm buying it for 60, okay. That was an example where the property's underwater, but I know that going in. I'm not intimidated by it. I know it going in. I don't want to think that I'm buying a $250,000 house. It's really only worth 100 that I paid 130 for. Now,
Yeah.
I will tell you again, quick story. So recently, and I'm going to tell you a story, and your investors are going to, and your listeners are going to go, "Wow, I want to jump in this tomorrow." But this doesn't happen every day. So you just get fortunate. So basically, we bought in a huge portfolio. We bought a loan in New York, and we bought it for I want to say around 200 to a quarter. And the seller believed the property was worth about 275. Okay. Now, depending on what street it was, what address it was, we had comps that were over $1 million. And what was really interesting was even though the projected value that my seller thought was two something, the legal balance was over like 1.1 million. So you
And
kind of
Jay,
wonder,
real quick, when you're saying seller in this case, you're talking about the note owner, not
correct,
the okay, good.
correct,
So that
correct,
note owner thought the property's worth 275.
right.
Okay,
So that's
follow
why.
you.
So that's why he was letting us buy it for like two and a quarter. But the legal balance like over $1 million. You kind of ask yourself how in this market. Now, granted, the 2009 market it would make sense, but here you got how would a property have $1 million plus legal balance? It was only worth 250 or whatever, right? Um, lo and behold, the borrower came to us and said, "Look, I'm selling the property," and he came to us and he said, um, in effect, I want to do a short sale. And that wasn't a traditional short sale. I think he did get some money out of it. But basically, we agreed to him that we would accept $952,000 to pay off our $1 million+ note that we only bought for two and a quarter. Our seller made a mistake on value. So if our seller realized it was worth, the house was worth over $1 million, we would have paid $800,000, $900,000 for it. We still would have made money, but not that windfall.
Wow. Wow, that's incredible. So just to play that back, because I know with the sellers and some of the terminology, people may get lost, but what you're saying here is that you came across this note. The note owner thought it was worth 275. You bought that note for two and a quarter. You said the mortgage balance or the balance there was over $1 million. You did a
Correct.
short sale for some 900 some $1,000, and you were able to make close to $700,000 or so on this deal, and you would have been happy making $100,000, right, or something close
Correct.
to that
Correct.
with the way
Correct.
you structured it. But this was really a slam dunk home run deal because the person who owned the note before you really just didn't know what the value was. Like, I think it goes right back to your point on due diligence, because I guess on the flip side of that, how are you verifying that information? Because I imagine that owner had to. Well, maybe I'm making some assumptions here, but are you just going on Zillow? I know you're not doing that, but like, what are you doing to kind of figure out what the property's value is in the present when you're looking to acquire it?
So we value our properties, a variety of ways. Our analysts are doing the comping like most people would. We've got boots on the ground in almost all jurisdictions, or can find a realtor that'll go give us a valuation. You can always pay for a BPO, which is not really the last resort because they're just done by the least experienced agent in an office. But no, but you got relations. Like I said, if we're buying, you know, constantly in New York, we've got relationships with realtors. That's part of our team in our markets. So you just lean on them and say, okay, give me an idea what the valuations are and stuff like that. So we know.
I love it. I love it. No, I think it's very, very important for people to understand is, you just called out those four steps for due diligence. One, title, make sure you understand you have a clean title, or at least understand where the title is at so you can clean up anything if necessary. Second thing you said was taxes, are taxes current? If they're not, if they're delinquent, if a lien has been placed on the taxes, just understanding where it is so you know what your business plan is going to be to get that rectified. Third was occupancy, which I want to come right back to. And then the last was value and understanding what the value of the property is. On occupancy, are you reaching out to these owners directly and talking to them prior to buying it? You just want to know someone lives there.
That's a federal regulation if I'm doing that before I own it.
Okay.
Yeah, I'm not gonna get involved I'm not gonna get violate RESPA and things like that. No, we engage our local realtors, whatever, just to kind of, do not get, do a drive by and just check occupancy. I mean,
Got it.
we're not formally engaging saying, hey, we're, thinking about buying the loan on your property. That's a violation. We can't do that.
Got it. And are you looking for anything specifically or just a check that, yep, someone lives there? Are you looking for like length of stay or anything like that?
No, no. Remember, we're in
Okay.
first position. I mean, we control the outcome for the most part. So we really am not. Second players are more concerned about what the borrower makeup is. What's his credit score? What does your job? Things like that, because they've got to work with the borrower more than we do, right? I mean, we choose to, but we don't have to because we with the power of first position. The one other thing in diligence that we do, because partly because of my background, is we will we determine where we are in the legal process. Like, remember, we're buying portfolio loans. We're buying one at a time, five at a time, 10 at a time, 50 at a time, whatever. Um, and so we're checking, getting the servicer notes, the collection notes, et cetera, from the prior servicer or the existing servicer. So we're checking out if the house is already in foreclosures. Remember, some of our seller relations will work the assets. So if it's in the process of foreclosure, we want to know where, right? We want to know if I'm buying, 40 loans and one of them's been heavily, heavily fought by the borrower for the last 10 years, I'll drop it. Why do I need the headache? I can buy 39 other loans, right? So that's important to us, is to find out where it is in the legal process and what the issues are, and is there any true realistic impediments of succeeding.
No, that makes a lot of sense, and I think it's obviously a smart way of running the business, recognizing, hey, how likely are these people to fight us and to have these issues, and understanding where things sit there. I want to talk a little bit about just the success of your business, and really, this is a two-part question, right? So, what are some of the keys to the success of your business, and then I want to get into kind of the capital raising side of it because most of our listeners are familiar with multifamily syndication and I presume note investing syndication is very similar, but I want to start understanding a little bit more about that space. But first of all, let's talk about your business. What do you think are some of the keys to success that you've faced?
The keys to success are creating your team. We've got about 13 employees, and they're just stellar individuals that know what they do, that love what they do. They're just awesome. I mean, we've got, my business partner runs more of the analytics side, so his analysts. I mean, I know I work with the analysts, but not very often. I work with, my loss mitigation team, my REO managers, my asset managers, and work with them on a daily basis. My asset manager just called me what is during this podcast. But anyway, um, uh, our team is solid. We know what we're doing. We do a lot of our work in house, which so not that we're control freaks, we just know we do it better. I mean, loss mitigation, we're the ones talking to borrowers. Third party servicers don't do as good a job. So that's why we can say we do loss mitigation very, very well, because we do it in house. Um, Kind of segueing into that capital raise side, it's we were allowed obtain the ability to scale from, yes, we started doing, like everybody else, doing, one asset joint ventures to, and as we started to scale up and buy higher value loans and buy portfolio loans, we started doing syndications. Similar syndications to any multifamily deal, except for in the beginning, there aren't, they're not in the beginning, only until recently are there lenders who will provide you debt on loans. Because here's the thing: why they don't know how to securitize it. We're not buying the property, we're buying the paper. We were fortunate enough to get an institutional private investor who really acts like an institutional investor, that brought in debt in January of 2022, which now allowed us to then, where a syndication would have been 100% equity, right now we're getting levering it with debt. So our capital raise or equity raise was less and more fluid, and we just allowed to scale up. And what that did was allowed us to start doing business with different hedge fund players. Like, if I've only got this kind of buying power, I'm dealing with hedge fund here. As I got greater buying power, I'm dealing with hedge funds higher up the food chain.
Yeah. I think that's really interesting just thinking about scaling in that space because We know that the market has, shifted, and there's going to be more and more opportunities. And I think those folks who are going to continue to be successful are those who are going to be creative, those who find, relationships, those who can figure out how to scale and how to put together kind of capital stack. So raising capital is going to look a little different. I love the way you just talked about, working with investors, maybe starting off in the JVs, but as you start bringing in, passive investors, changing up that capital stack and maybe getting those institutional level of investors where now you can work with larger hedge funds and get maybe a nicer, higher quality package of notes that you're acquiring. Is there like kind of a common mistake you see, or one thing you wish everyone would know about note investing?
I think that um, the biggest thing I see, I wouldn't call it a mistake, just kind of inexperience. Is the inexperience. Guys jump into this business. You know, I'm 10 years in. There's a lot of folks that I've come across that are no longer in this business for a variety of reasons. Most of which is just kind of like any other opportunity. They get in. There's that frenzy. They want to buy. They're inexperienced. They don't know what they're doing. They overpay. And when you overpay, they lose money and they're soured on the opportunity. Um, so that I think is the biggest mistake. So get educated or partner up with those who are educated. So you're going in this, with some level of expertise. That's I think the piece of wisdom that I would subscribe to, or just invest with other companies that know what they're doing. I mean, that's just kind of you partner up with those that know what they're doing, and you learn from there. Because going out on your own, it's if you want to be the lone wolf, some people do it well, some people can't. I'm not a good lone wolf.
Yeah.
It doesn't work for
And,
me.
and Jay, I think that's great advice, right? Is listen, if you want to go the lone wolf route, you can, but if you have zero experience, then you're trusting yourself with no experiences. You're setting yourself up to fail, right? I think a great way to try anything is to invest passively in a group that you've vetted that knows what they're doing. Even if the deal doesn't pan out as well as you like, you're going to learn and get that education and know the big issues to avoid, or at least get further along in your investing journey. And maybe you decide you don't really want to be active and you just enjoy putting your money out there, but maybe you get a little bit further along. And for those folks who are interested in that, they can check out your website, Scottsdale Mortgage Investing.com, and they can learn a little bit more about you and your company and the things that you are working on there.
True. I don't know if it's mortgage investing or mortgage. I think it's got some mortgage investments. Our email address is
You're
investing.
right.
I think
it's
you put,
investments. I'm completely
yeah,
wrong. You're right. I was looking at the
yeah. No,
email.
I gave it to you wrong because
Scottsdale,
I never
Scottsdale
look at
Mortgage
my
Investments.
website.
You're right. It's Scottsdale Mortgage Investments.com. Jay, we're going to transition to our round of insights. Are you ready?
Sure.
Give me a failure or an apparent failure that sets you up for later success.
Uh, Prior iterations, I've been with Scottsdale since 2018, but I've been in this business since 2013. And my choice of business partners prior to there was didn't were not good for different reasons. And about the 2 year mark of both those other relationships, that kind of fell apart. And I think that with my current business partner, about the 2 year mark, I think I inherently tried to sabotage the deal, and I didn't. And we've been business partners almost 6 years now, so that worked out.
Give me a digital or mobile resource you recommend for your business.
Digital or mobile resource? I'm not I'm more old school. Our website. You subscribe to our trade desk. Digital, I mean, everything's online these days. You can look up court, stuff. You can look up taxes. You can look anything's, government websites. Anything's digital these days. In our business, everything's digital.
Give me the book you recommended or gifted the most in the last year.
2 books: 3 Feet from Gold or Who Moved My Cheese.
All right, I like those. All right, give me a daily habit that helps you stay focused on your goals.
Daily habit. Get away from the computer at certain intervals and just go take a walk. I mean, you can be tied to your chair all day and just, when the pandemic hit and everything else, everybody got on Zoom and everybody loved Zoom and a lot of businesses grew by Zoom. I'm bored working at home.
Getting out there. I get it. I get it. All right. Give me your number one insight for investing in notes.
Like I said before, partner up with somebody that knows what they're doing. Get educated. Get educated. Do it well. Do it smart. There's no there's the note business side is the the area of abundance. It's co-opetition. It's not competition. So it's like train those, be trained. Be open to be training, because as an inexperienced investor, if you're overpaying for loans, you're affecting my business, because now that sets the bar that I don't have to achieve. So get educated.
All right. And Jay, where are you located right now?
I live in a suburb of Phoenix, Arizona,
All
where
right.
the temperature today is probably not even gonna hit 60 degrees, which in some areas you're like, wow, that's balmy. But no, I mean, it's a desert. It's the highs and the lows. It's better than 115 in the summertime, but it's cold. It's cold here.
Well, out there in Phoenix, I want you to give us your favorite place to grab a bite to eat.
Uh, there's tremendous steakhouses in Scottsdale. In fact, my wife and I just went to Dominic's. Past everybody's got the Mortons and all that, but there's a place. Dominic's is good. There's a kind of a different place, Montauk in Scottsdale, which has got great lemon drop martinis and great food. Place like that, yeah.
All right, two really good options there. Jay, you gave us a lot of great feedback. I appreciate you breaking down your approach to note investing with your background and why it kind of made sense for you. And I really like too, just you talked about kind of your origin story getting into it and wanted to be a real estate investor for a long time and just you would go to those weekend workshops and come Monday, nothing happens. And finally this thing felt more natural and it was an easier and on ramp for you. And you've kind of found your niche here. I like the way you talked about, the four steps you use for due diligence, understanding the title, taxes, occupancy, and then also the value. And then also talking about a little bit about why you focus on first position loans as opposed to second or junior positions and, or buying performing notes. So I think really good information for people to wrap their head around note investing. And again, that last point you gave, if you really want to get into this space, find somebody who's got experience to partner with or teach you the ropes. You can check out Jay at Scottsdale Mortgage Investments.com. Check them out there. And Jay, I just want to thank you again for being a great guest and coming on Multifamily Insights.
John, my pleasure. Thank you so much for having me.